Yes. So we have like this extreme in our house, right? Like but in terms of sort of what they're thinking and where they're going.
Yeah.
So it'll be interesting.
Yeah.
Yeah. All right.
All right, we are good with our camera shots, and we have started camera roll. So, Catherine, having you looking at your main camera, I'll do a 3, 2, 1, and then after 1 will be silent. You can start anytime after that. Okay?
Got it.
Everyone stand by. Nice mouse to start there. And in 3, 2.
Good afternoon, good morning to everybody. I am so excited to be having a discussion today with Glenn and Elizabeth. First of all, I can't thank you enough for coming because I know how busy both of you are. Many of you on the other end know me well, so I'm going to go right into introductions. And I do believe the best way to introduce is to introduce yourself, to tell your story. So I'm going to start with you, Elizabeth. If you can tell a little bit of your story, how you got to where you got to, and sort of maybe a fun fact, just so that people get to know you on a more personal level.
Great.
And then Glenn, get ready because you're next.
Well, thank you. First of all, thank you for having us. What an honor. My name is Elizabeth Weymouth. I am the founder of a private equity firm called Graphene Partners. Graphene I built, started around 2019 to really be an antidote to the explosive growth of the alternative asset management industry. So at Graphene, we're focused on finding high quality private market alpha, unique deals in the face of perhaps private market beta that some of the bigger platforms are providing. All good, of course. We can go into details a little bit later as to what we do, but at the core, we are seeding the next generation of private equity leaders and partnering with them to get deal flow for our investors. My story is after University of Virginia twice, went to Darden, went to JP Morgan and started my career. In 1994, was lucky enough to join JP Morgan Securities in the earliest days and was part of a team that built up from scratch the investment business at the JP Morgan Private Bank. So I was there for 13 years. We built out every aspect of it, and this is where I got to know Glenn. He'll tell you in a moment his story. It was quite remarkable. But had the opportunity to build a business that was, I guess, zero AUM to begin with, and then grew to 300 billion over 13 years, and ran the U.S. investment business there, which was 80 billion of that total. Found that alpha was being generated in the alternative space, and then was very susceptible to a tap on the shoulder from Carlyle and Riverstone, where I became a partner for, and I stayed there for 10 years before forming Graphene. So a little bit of energy in my background as well.
That's awesome. Fun fact?
Fun fact. Let's see. I was born in Mississippi. People don't often guess that. And my mother is from Denmark, and I do speak Danish.
Wow. All right. Glenn, you got to beat that fun fact.
I'll try. I'll try.
I'm sure you can.
So a little bit about you and for the team so they can understand your background, where you came from, Glenn?
Sure. I have been in different forms in the alternative asset management world for 40 years. And I kind of think about it in 3 different segments. The first segment was a business that I started with a childhood friend called Dubin and Swieka. It was one of the early fund-of-funds businesses that we started in 1984. And we had early mover advantage in the hedge fund industry, met some really fantastic hedge fund managers, and began allocating capital to them in a systematic way. And then I guess it was the late 80s, early 90s, we said, this is terrific. I mean, we're running $1 billion of assets under management, which is an enormous amount of money. However, we said, wouldn't it be interesting to be on the principal side of the transaction as opposed to being an agent and allocating capital to others? And really what was the driver of our fund-of-funds business was modern portfolio theory. We tried to identify these uncorrelated return streams in the form of independent investment managers. And then we said, well, let's become principals. And so we started in 1992 a multi-strategy hedge fund called Highbridge Capital. And again, borrowing from those principles of modern portfolio theory, let's try and find uncorrelated return streams in the form of different strategies. And so we built Highbridge into a multi-strategy business. In 2005, we sold a majority interest in our business to JP Morgan. And there were many cynics out there that said, oh, these guys are selling out, and aren't they shrewd? They're selling out at the top of the hedge fund industry. Well, we didn't sell out, nor did we think it was the top of the hedge fund industry. We wanted to associate ourselves with a major financial institution and learn best practices about continuing to build a world-class asset management business. And so the partnership with JP Morgan was fantastic. It was originally supposed to be 5 years. I ended up staying, I believe, 8 years. And we went in 2005, we were a $7 billion multi-strategy hedge fund business. When I left at the end of 2012, beginning of 2013, we were at $35 billion of assets under management. But I think most impressively, thanks to our partners at JP Morgan, we were able to diversify our business far beyond traditional hedge fund strategies. And really some of the key strategies that we were able to develop with our partner at JP Morgan, we built a merchant energy business with a partnership with the Louis Dreyfus family. We built a private credit business called HPS, Hybrid Principal Strategies, and I know you're going to ask about some of the merger and acquisition activity out there. We can talk about the HPS transaction with BlackRock. And we built a mutual fund business. We took some of our alpha engines in the hedge fund strategy and developed CCAVs and 40 Act mutual funds. So it really was a fantastic partnership. In 2013, kind of the third segment of my career, I left to start my family office, Dubin and Company. And I really didn't want to be a passive allocator of capital to third-party managers. I had the interest in continuing to build and grow and develop businesses and strategies, but I felt I should be informed by my experiences in the hedge fund world. So over the last 11 years, I've built out Dubin & Co. in a diversified way. In the businesses that we've built, first one was going back to the folks at JP Morgan and the Louis Dreyfus family. We created this merchant energy business and asked them if they'd be interested in selling that business, which they did. And we created an independent energy merchant by the name of Castleton Commodities International. We did that in 2013. The next thing that we did within the family office was develop a quant equity business, again, informed by my experiences at Highbridge and JP Morgan. And we created a business called Engineers Gate. In 2020, we spun that business out. It's now an independent hedge fund, quite successful, being run by my partner, Greg Eisner, who's been with me at Highbridge since the early days. And then in 2014, I began to invest some capital in early stage biotech. And my wife, who's a physician, said to me, what are you doing? You don't understand science. You're going to lose all of our money. You better get somebody that understands the science of what you're investing in. And so I went to my then daughter's boyfriend, he's now her husband, and said to him, he was 30 years old at the time, he went to Harvard, smart young man, and I said, I'm looking for somebody in your vintage that maybe you went to school with, maybe you know that went on to get an MD, PhD, and he introduced me to a former classmate of his at Harvard that in fact went to Penn Medical School, graduated #1 in his class at Penn Medical School, which I thought was a great accomplishment, got an MBA at Wharton, and we ended up seeding him in a biotech business that is one part public equities and one part private investments in biotech. That was another business that we created. And then I did some venture investing. And then finally, which is something that I told Elizabeth I'd like to talk to her about, one of the venture investments I made was in a consumer company about 5 years ago. Somebody introduced me, a dear friend of mine introduced me to a company that was just starting, a non-alcoholic beer company. And the thesis behind investing in this company was The world is getting healthier. The United States is kind of leading that effort. Low alcohol, no alcohol. And this is a fantastic product, unlike the other products that are out there in the marketplace that don't taste very good. And so I invested in a Series A round of a company called Athletic Brew.
I was going to guess that. That was the one. Everyone drinks it.
That's turned into this great success. But more importantly, not more importantly, but equally as important, is that it opened my eyes to consumer investing, which I'd never done in my entire career. And my son, after working at Goldman as an analyst for 2 years, went to work at L. Catterton, a large and very successful consumer-based private equity fund. And he called me almost 2 years ago, and he said, "Dad, would you like to meet one of the senior partners at L. Catterton? He was here for 10 years. Everybody thought that he walks on water in terms of identifying companies. He's responsible for 3 of the most successful deals in Catterton's history. Would you like to meet him?" He left a month ago and started his own fund. He wants to start his own fund. And I said, "Well, why did he leave?" And he said, "Well, the reason he left is because his deal flow, his proprietary deal flow, was focused on small middle market companies where the equity check was typically anywhere from $25 million to $200 million maximum. And Catterton had grown to be a $30 billion private equity fund. And for them to move the needle, they really had to write a $500 million equity check or more. So he left, and I said, "I want to meet him." And the good fortune is I met him. We seeded him and started a small middle market consumer fund as well. So it's been fantastic over the last 11 years, kind of been informed by my experiences in the hedge fund world, learned a little bit about the private equity world and venture investing, and now have a diversified family office.
That's awesome. Fun fact?
Ooh, fun fact. Well, you speak Danish.
Yes.
I'd like to say I speak Swedish. I should speak Swedish because my wife is Swedish. All 3 of my children are fluent in Swedish. And I have a vocabulary, after being married for 32 years, sadly, of only about 20 words. However, I understand Swedish. And we go to Sweden every summer and spend 2 weeks there. And it's part of my family's background.
Awesome. Do your boys speak Danish?
They have all been to Denmark. I used to go annually, like your boys did. And they have probably a limited vocabulary of about 5 to 10 words, including "I'm hungry, I'm thirsty, and I'm tired," and "Where's the bar?"
Yeah. I love it. What's so clear from both of you is your passion and your joy. Like, we talk a lot about having passion and joy in what you do. It's very clear that both of you love what you're doing. And you've had many careers in many different sort of keep and changing. When you think about the asset management, especially the alternative, to your point of the length of time you've both been in it, when each of you, could you think through what would you say is the biggest opportunities out there today and how you see that in your jobs and what you do today?
Sure. I can jump in. Should I start?
Please.
And then we'll hear from Glenn too. The reason I started Graphene, because I think this is a big opportunity that's only scratching the surface, is that the alternative asset management industry, in my estimation, is now more mature. So over half of the firms, private equity firms that are out there, are over 20 years old now. So that's a new milestone. As they mature and grow into really the business plans that they're adopting are to be more like Fidelity. So we have Blackstone crossing $1 trillion of AUM. Carlyle, Blackstone, Apollo trying to get very close to that and equal that. As that happens, these are more supermarkets, if you will, of alternative asset management. There's absolutely opportunity in that. But I would argue that as they grow, size becomes the enemy of returns. And the investor base, if you go to that element of our business, has become only more sophisticated. So this is a group now that has also 20 years of experience. And the more sophisticated private asset investors are still looking for alpha, that outperformance that can happen. Not that the beta, as we called it a little bit earlier, is bad. private equity top quartile managers have outperformed the S&P 500 consistently. There's not a time when they haven't. But even within the alternative space, there's alpha to be had. So how does that happen? When you think about where the capital is going, so I'm going to bring up a few dynamics that I think lead to opportunity. The capital, because of lack of distributions and other aspects, has really been going to the existing relationships of many of the biggest investors. So I think, even the first 6 months of last year, 64% of capital went to the top 10 by size funds in private equity, which meant 36% was available for everybody else. And you had this phenomenon, which we've keyed into, of people wanting to start new firms, despite all the fundraising drama and noise. If you're looking for alpha and you can support a group of people who are starting to spin out of the bigger firms that have 10 to 15 years plus of experience investing in a certain sector with track records you can verify, you start to de-risk this. You find an interesting, sort of less risky way to get at alpha because these people have proprietary deal flow from networks that they have cultivated over the last 15 to 20 years. They aren't necessarily executing a deal from a banker book from Morgan Stanley or Goldman Sachs or whomever. They're really working with their management teams and CEOs to really build a company. They don't know two things when they start a firm usually. They don't know where strategic capital is to finance the deals in their pipeline. If they don't get those deals done, there's no them in the future. So they'll do anything to figure out where the capital is. They also don't usually know how to build an institutional quality firm. And that is the risk of emerging managers is rarely in the deal. It's mostly in the founder dynamics and how things start. So if you could help, which is our entire business model, so this is completely self-serving, if you could help solve that problem that these rock stars, potential rock stars have, you start to forge partnerships and you can get their deal flow for investors, our investors in this case. But I think there's a lot of opportunity in this emerging manager space. The emerging managers, I don't love that as a phrase. I think these are sophisticated veteran investors launching new platforms, but I think you can find some great deal flow and some great opportunities for outperformance that complements one's exposure to, a mega fund, if you will. So that's one part. I could also go into secondaries and other things that I think is opportunity, but I'll pause for a moment.
I like that it's also allowing them to do what they're good at, right? Versus like having them do the stuff that maybe isn't in their bailiwick.
That's right. And as firms get bigger, and Glenn just said it beautifully, like the firms need to do bigger deals.
Yeah.
They can't focus on the smaller ones, whereas you might have preferred to do smaller deals and start your own firm. So I think there's opportunity there.
That's great. What about you, Glenn, from an opportunity standpoint or even a risk standpoint? You can cover one or the other.
Yeah. Well, I very much agree with Elizabeth. There's an opportunity in the small middle market space, certainly in private equity, for the reasons that Elizabeth mentioned, but also the common thread through all the businesses that I've started in my family office over the last 11 years have to do with smaller capital bases where there's alpha. And the reason that there's alpha is because the alternative managers, whether they be hedge funds or private equity funds or credit managers, typically with success, with investment performance success, they grow bigger. And as they grow bigger, the opportunities in the small middle market space or the less liquid space becomes very difficult for them to invest in. And it leaves a vacuum. It leaves a void. And, as I built these various businesses in my family office, I'd like to say, gee, I knew that the common thread across all of them was that this is going to be in the, where big managers have abandoned the space and have created alpha. But as I look back now, 11 years later, that is the common thread. In the energy business that we started, we trade in a lot of markets that the big majors can't trade in. And our returns have been exceptional, and we don't want to grow, and we return 30% of our EBITDA every year to shareholders to maintain that sufficient size that we get in and out of those less liquid markets. Same thing with the quant business. In the quant business, we're focused on higher frequency and mid-frequency trading strategies, higher Sharpe ratio, but the capacity is not that great. Biotech, small middle market biotech, where the great successful biotech investors started in the small middle market space, but have now, because their assets have grown, are now running 10, 20, 30, $50 billion of capital. They have migrated to the large cap space. So a lot of alpha left behind. And same thing with the private equity business. This is a gentleman, a fantastic career at one of the large, very distinguished private equity firms, but they had grown to $30 billion of assets under management. And to do a private equity deal, writing a $25 million check or even a $100 million check just doesn't move the needle. So there is that common theme that below the radar screen, smaller, less liquid markets, significant amount of alpha available.
So it's interesting, when you talked, Glenn, a little bit about your history, one word you mentioned I thought was interesting is the sellout. Did you sell out to a big institution? And you were seeing these big, and we talk about the big, right? And both of you have been in big, and you're doing this, the sort of entrepreneurial side now. What is your view a little, Glenn, as we talk about M&A and the big getting bigger? You talked about HPS and that deal, and you look at even the institutions looking at private credit, which, by the way, isn't new. Both of you have talked about being in the private credit business 40 years ago. What do you see M&A going with the bigs, and what does that mean for the emerging or for the small, sort of in your history of what you've seen, Glenn, and where do you think that's going to go in the next few years?
Yeah. Well, I think one of the biggest secular moves over the last 15 or 20 years has been the alternative industry replacing